Welcome to Chapter 18. In this chapter, we'll be discussing the accounting for income taxes. The midterm exam is right around the corner, and I can assure you that there will be a question related to income taxes on the exam. So I'm going to cover income taxes in quite a bit of depth, and I'll go through a number of questions during the tutorial sessions to try to make sure we're all comfortable with this topic. Accounting for income taxes is complex and it's not well understood even by many practicing CPAs. So if you can understand this topic, you'll not only do well on the midterm exam, but I'm sure you'll add plenty of benefits to your existing employers. Let's get started. So our first learning objective is to understand the importance of income taxes from a business perspective. When a company decides where to set up operations, the tax rate that it will face on its profits is a major consideration. The tax rates can significantly slow growth of businesses, and this is a reason why the Canadian government has been attempting to reduce taxes for the past 20 years. The combined federal and provincial tax rates across Canada range from about 26 to 31%. As at 2018, they haven't differed a ton since there. And our focus on this chapter is on financial reporting once companies have determined the amount of taxes that they owe. And this is a really important point because what it means is a good news item, meaning that we are going to defer the calculation of taxable income and understanding the nuances between what a company has to pay tax on versus what we're going to record in our financial statements for your in-depth tax course. That means that in the questions that we're given in this chapter, we'll be given the tax implications or told when the items need to be recorded for income taxes. So we don't need to worry about understanding what's taxable and what is in our financial records. What we really need to do is just know what to do once we know that there is a difference between the two. Corporations file income tax returns that are administered by the CRA and also provincial legislation. And because our financial reporting, which might be in compliance with might be in compliance with IFRS or ASPE, both of which can be referred to as GAAP or generally accepted accounting principles, they differ from the CRA regulations. This causes a difference between our accounting income and our taxable income that we need to deal with. And these adjustments result in the current year's pre-tax income and the taxable income to differ. All right, we're already on our second learning objective. So learning objective number 2 is to explain the difference between accounting income and taxable income and calculate taxable income and current income taxes. Well, what's the difference between accounting income and taxable income? So we talked about this a little bit in learning objective number 1, but let's take a better look here. So to illustrate the differences, let's look at this example. So you can see that on the left-hand side, we have financial reporting. So we've got an income statement or a partial income statement of Chelsea Incorporated here. And you can see that they've reported in their IFRS financial statements, they have reported revenues of $130,000 every year and expenses of $60,000 every year. So perfectly flat financial results. And they've yielded accounting income pre-tax of $70,000 every year. So their total income across the 3 years is $210,000. On the right-hand side, you can see the taxable income that's been determined according to tax legislation. And so we can see that the revenues in the exhibit there, the revenues differ. So we can see that the revenue in 2020 was $100,000, not $130,000 like accounting. And 2021 was $150,000, so even higher than what we reported for accounting. And then 2022 was $140,000, higher than what we reported under IFRS. And it gives us a description in the notes there, saying that this is because of the revenue that was recorded for accounting purposes was taxed differently. So it was taxed as 100,000 and then 150 and then 140. And there's no change to the expenses. So what you can see if you look at the bottom line between the two exhibits is that our accounting income was 70, 70, 70, resulting in a total across the 3 years of 210. And our taxable income was 40, 90, and 80. So it was down, up, and then down, not flat like we had in IFRS. But in the end, across the 3 years, we still ended up with taxable income of 210,000. So what this highlights is that many of the differences between accounting and tax are timing differences. And the timing of income means that it's only a temporary difference. So it's going to exist in 1 year. We may have higher or lower tax, but in the end, it's going to even out to that same number, that same 210,000 in this example. So in reality, companies don't prepare a separate income statement according to IFRS and according to tax. What we do in reality is we prepare a reconciliation. So we start with our accounting income, which is these are the exact same numbers from the two exhibits we just looked at on the prior slide. So our accounting income was $70,000 each year. And then what we do is we run through what's causing a difference between that and our taxable income, which is the second bolded line in this exhibit. So as an example, we were told that the warranty revenue that we recorded was, let's take a look back. So the CRA has different rules for including reported revenues and taxable income. The 130,000 of revenue that was recorded each year was taxable as 100,000. So what that means is that in our accounting income, we had recorded 100,000 of revenue, net of our 60,000 of expenses, which gave us the $70,000 net income. But we can't record the 130,000 of revenue. We can actually only record 100,000 from a tax basis. So therefore, we add back $30,000. Sorry, we take away $30,000 because we're reducing the revenue that that company would have recognized. So if the company had only had 100,000 of revenue and 60,000 of expenses, they would have had taxable income or net accounting income of 40,000. And then 2021, same thing, but now we are going to be taxing that revenue because the 30,000 that we took out of 2020, we're going to be taxing it in 2021 and 2022. So because we're taxing the 20,000 in 2021, we're adding it to the revenue that the company recorded from accounting purposes. So we're going to take 130,000 minus 60,000, and we're going to add 20,000. So we're going to have net income of 90,000. And similar for 2022, where we're adding back the additional 10,000. So what you can see, if you just look at that, the reconciliation part of this exhibit in the middle, we can see that we're taking out the 30,000 to 2020. So we're saying our taxable income is lower than our accounting income by 30,000, but then we're adding it back in the 2 later years, again, illustrating that this is a timing difference, because in the end, we still end up with the 220,000 of income. 210,000 of income across the 3 years. So it's really just a timing difference here. And you can also see that we've calculated taxes payable here by just taking our taxable income and multiplying it by the tax rate, which we're saying is 25%. And that yields our taxes payable. And we'll take a look at that again in a few slides. So temporary versus permanent differences, what does that mean? Well, the accounting treatment and tax treatment for temporary differences are the same, but when they're included in income is different. Example is that 30,000 of revenue. We said, the tax authority said, listen, you can include this in 2020, but you can include it in 2021 and 2022. So they're saying, listen, you can still include it, but you just can't include it this year, you can include it that year. That's what we're saying there, is that the accounting treatment and tax treatment are the same, it's just the timing that's different. And the original differences causes the difference, where we subtracted the 30,000, then we added it back. So in the end, it nets out. However, some differences between a taxable income and accounting income are permanent. And these are differences that will never be included in taxable income. So we might have subtracted an expense for accounting purposes, but we'll never be able to include it for tax. Or it's going to be an item that's included in taxable income, but never included in accounting income. And the most common examples of permanent differences are related to fines or penalties, where we deduct those amounts from our accounting records, but they cannot be deducted for tax purposes, so they always need to be added back. And the same thing with non-deductible club dues. So often companies may pay, or especially in textbook examples, they'll pay, golf club dues or maybe Terminal City club dues for some of the executives. That's fine. We can deduct those expenses from our accounting records. Nothing in IFRS says that can't be deducted. But for tax purposes, those are not eligible expenses, meaning that they always have to be added back. And if those were our only differences, we would have higher taxable income than accounting income. Let's take a look at some examples of differences between accounting income and taxable income. And these are examples that are going to play out in one of the next questions that we look at for Chelsea. So they are going somewhere, and they'll also give us a good idea of what type of differences could exist. So for revenue, let's say that from accounting, in our accounting rules, we recognize 18,000 of revenue. But then from a tax basis, we can't record that revenue until the cash is collected, and the customer is going to pay us $1,000 per month. So what would that look like in that accounting reconciliation? So remember, where we have accounting income, then we have some differences that we're reconciling across years, and then we have our taxable income. What would the impact be on an imaginary reconciliation of such? Well, we would need to add back the 18,000 of revenue that we had, or we need to subtract the 18,000 of revenue that we recorded in 2020, because for tax purposes, that's our taxable income will be lower. And then in 2021, we'll have 12 months. So 12 months times 1,000 per month, we'll add 12,000 of taxable revenue in 2021, and the remaining 6,000 in 2022. And as you can see, we've got 18,000 being deducted in 2020, but then being added 12 and 6 in 2022. That all evens out across the years. That means it's a temporary difference. Okay, for expenses, let's say 5,000 is deducted as life insurance expense on key officers in 2021 and 2022. Now, the tax authorities say you can't deduct life insurance on key executives. So that means we need to add this expense back in 2021 and 2022, meaning that it can't be deducted. So it will adding back an expense will will increase our taxable income, sorry. So, and that's a permanent difference because it doesn't even out. We're simply adding it back. It's never going to even out. What about a warranty of $30,000 that was provided on sales, and we accrued it as an expense for accounting purposes in 2020? Well, say the tax rules say that this is taxable when the warranty work is actually incurred. And they give us the timing of that, 20,000 in 2021 and 10,000 in 2022. Well, in our reconciliation, we'll have to add back the expense that we deducted, 30,000 in 2020, and then we can deduct 20,000 in 2021 and 10,000 in 2022. Again, it's a temporary difference. So those are some examples to give you an illustration of what temporary differences are, which is the cash collected here and the warranty revenue, and then a permanent difference, which was that life insurance expense on key officers. Permanent differences can still end up running through our schedule. Of course, they still need to be reconciled between accounting income and taxable income, but they're never going to even out. So whereas we have an add and then a subtract and it all evens out in the end, permanent differences are just, that's it, like add it back, move on. So below is the completed reconciliation between accounting income and taxable income for Chelsea, going through the examples that we just walked through in the table. So you can see we've got our accounting income of 200,000, which must be given. And then we've got our adjustments for the revenue from the sale, our warranty expense where we're adding back that 30,000 that we deducted as an expense and then subtracting it later. And you can see the permanent difference for the non-deductible insurance expense, we're simply adding back the 5,000 each of the 2 years that was expense for accounting purposes. Again, this says nothing about our financial reporting. It's completely fine the way that our accounting income was calculated. It's just that when we calculate taxable income, because there's different rules, then we end up with these reconciling items. Okay, so let's talk about current income tax expense. So actually, let's talk about total income tax expense, of which current income tax expense is part. So total income tax expense under IFRS is composed of 2 parts. The first part is current income tax expense. And this is simply your taxable income. So you've got your reconciliation, so you've got your accounting income, you end up with some items in the middle, and then you've got your taxable income. Your taxable income times the tax rate, say 25%, is going to give you your current income tax expense. And the journal entry to record current income tax expense is very simply debit income tax expense on the income statement and credit income tax payable on the statement of financial position. And then of course, if we pay it out and when the taxes are due, then of course we'll clear out the payable and credit cash. Now, deferred income tax expense is our second component of total income tax expense. And deferred income tax expense recognizes the accrual of the impact of the differences between accounting income and taxable income, which will result in the company paying more or less tax in the future. So if we think about accrual accounting, you know how as soon as we know that we're going to have a liability or possibly an asset, we need to record that for accounting purposes, depending on what criteria is met? Well, this is exactly the same thing. So we've got our accounting income up here and our taxable income down here. Now, there's going to be a difference between the two. Let's say that our accounting income is higher than our taxable income. Well, that must mean in the future, as that reverses, something is going to happen to our tax expense. So we need to record that at the date that we know it's going to exist. And that's what deferred income tax is. And this ensures that our total tax expense relates to the period in which the accounting profit is made. So when we show on our income statement our tax expense, we're going to have 2 components. We're going to have current income tax expense and deferred income tax expense, and they're going to be shown separately. Now let's pause here and talk a little bit about how ASPE and IFRS are different. So there's a few differences between IFRS and ASPE for income taxes, both in measurement and in terminology. So in terms of measurement, ASPE permits an accounting policy choice to use what's called the taxes payable method. This method is so simple. You just ignore deferred income tax. You just simply calculate your current income tax expense, and that's it. You just ignore everything else. It's very, very simple, but it's not considered conceptually as sound as the IFRS method, but it's very simple. So companies that report under ASPE are permitted to choose this as an accounting policy choice. IFRS, on the other hand, requires the temporary difference approach, which is what we just talked about, where you're going to have your current income tax expense and also record any changes in your deferred assets or liabilities. And we'll talk a lot more about that later on in the lecture. And this method, the temporary difference approach, is also permitted under ASPE. Now, the other thing that's different between IFRS and ASPE is terminology. So if under ASPE, a company elects to apply the temporary difference approach, which is what all companies reporting under IFRS have to report under, then the calculations are exactly the same. So at least there's no other weird nuances in there. And however, the terminology is different. So for some annoying reason, we have completely different terminology between IFRS and ASPE, but realistically, it doesn't really matter because it's the same thing. But as you're looking at companies' financial statements and as we're working through questions in the tutorials, and it's a possible multiple choice question on an exam, we do need to be aware of the differences in the terminology. So IFRS calls it the temporary difference approach, and ASPE calls it the future income taxes method. And under IFRS, when we have a deferred tax asset, ASPE would call that a future income tax asset. And same thing for a liability, and a deferred tax expense is future income tax expense. So basically, where we call it a deferred something under IFRS, ASPE calls it a future income tax something. So I can understand the idea of calling it a future income tax. That really is what it is. But under IFRS, we're calling it deferred tax. So the calculation of current income tax. So as mentioned, current income tax is very simply our taxable income times the tax rate. So assume the tax rate is 30%. Our taxes payable in the example that we looked at for Chelsea are going to be as follows. So we've got that same reconciliation we already reviewed on a prior slide. And now we're simply going to say 30% tax rate times the taxable income that we calculated is going to give us our current tax expense. On the journal entries to record our current tax expense are very simple. We're simply going to have debit current tax expense each year and credit income tax payable. And each year, we're simply going to record exactly the amounts right off our calculation on our reconciliation here. So in 2020, we've got 63,000, 2021, 59,100, and 2022, 60,300. You can see those amounts reflected here, and our entry is the same each time. Debit current tax expense or debit current income tax expense, and credit income tax payable. All right, that takes us through to learning objective number 3. So just before we move on, I just want to pause and say it's really important to highlight. So in total income tax expense has 2 components. Current income tax expense, which we just talked about, which is simply our taxable income times the tax rate. Debit current income tax expense, credit income tax payable. And then we've got this deferred tax piece over here, which we will get more into. And these 2 components together are going to be reported in our income statement separately, and together they'll yield our total income tax expense. Learning objective number 3, explain what a taxable temporary difference is, determine its amount, and calculate deferred tax liabilities and deferred tax assets. Okay, so deferred tax expense. So only temporary differences create deferred tax implications. And the accumulated tax effects of temporary differences are recognized on our statement of financial position. Deferred tax expense is based on assets and liabilities and is a statement of financial position concept. This is really different because everything we've looked at so far in this chapter, where we've been calculating the reconciliation between our accounting income and our taxable income, has been based on income and expenses, whereas deferred tax is based on our statement of financial position. So we kind of need to change our mindset here. And if the settlement of a temporary difference from a statement of financial statement position will result in more taxes, then we're going to have a deferred tax liability. And if it's going to result in less taxes, then we're going to have a deferred tax asset. So the carrying amount of the assets in our financial statements represents future economic benefits. So let's just think about a piece of plant, property, and equipment. Let's say we have a machine that we've capitalized and it's got a carrying value of $30,000. Now, the way that we can recognize this, if we think way back to the criteria for recognizing an asset, is that that asset has to generate economic benefit of the $30,000. So maybe we generate profit, we use that asset to produce pillows, and we sell the pillows to generate profit. Well, that piece of machinery that we have on our books for $30,000, it needs to be able to support us in earning that profit of at least $30,000. And those are what we refer to as future economic benefits. And when the future economic benefits are realized, so again, thinking about that machine that we have capitalized with the carrying value of $30,000 in our financial statements, there will also be future tax expense. So we said that that machine is going to be used to generate accounting profit. Now, as we generate profit, we're going to have tax expense. So if we're generating positive profit, we're going to have to pay current tax expense on that. So we know that as we're realizing those economic benefits, we're going to have to pay tax on them. So that machine of $30,000 can result in future tax owing or future tax consequences. And conversely, the carrying amount of liabilities in our financial statements represents future outflows that we're required to settle. So if you think about an accrual of $30,000 for a warranty that we need to pay for, warranty work we need to pay for, now we're going to have to pay out that $30,000. We're just accruing it for financial statement from a financial statement perspective, but obviously we're going to actually have to realize that liability at some point and make the outflow to pay for the $30,000. And when we incur an expense, assuming it's held constant with our income and like that's the only thing going through, then we're going to actually have cost savings from that, because an expense is going to decrease our income, which is going to decrease our income tax. So it's possible that that would result in future tax savings. So in order to calculate the deferred tax impact of an asset or a liability, again, reminding you that it's a statement of financial position approach, we need to know what the tax base of the asset or the liability is. And what the heck is a tax base? Well, let's work through the examples here, and then we'll walk through a number of examples, and then that will help us understand how we're going to use the tax base definition to calculate whether there's a deferred tax asset or a deferred tax liability in relation to that item on our statement of financial position. So the tax base of an asset. So when we need to figure out the tax base of an asset, we're going to say, is the future economic benefit taxable when it is realized? Or put another way, is there a taxable temporary difference that will result in us owing tax in the future? If the answer is yes, then our tax base will equal our future tax deductions. And if no, meaning that there are no temporary differences related to the asset, then the tax base equals our accounting carrying value. And deferred tax liabilities are computed by multiplying the difference between the carrying value and the tax base by the tax rate. And let's see what that means. So here's an example. So a capital asset was acquired at an original cost of $5,000. The company uses the straight line method of depreciation over the useful life of 2 years. The CRA permits 100% deduction of the asset in the first year. What is the tax base of the asset each year? And what are the deferred tax consequences, assuming the tax rate is 30%? So this schedule here is really helpful in setting up to calculate the tax base and the deferred tax implications of assets and liabilities. So let's start with assets. So we've got, on day one, we acquire this asset. And the asset has an original cost of $5,000. So our carrying value in our financial statements is going to be $5,000. And we do expect to generate economic benefits of at least $5,000 of this asset. The tax base of this asset, or our future tax deductions, how much of this asset can we deduct from our taxable income in the future? Well, none of it's been deducted so far, so we can deduct the whole amount at some point from taxable income. So our tax base is also going to be $5,000. We haven't used any of it up. So the difference between our carrying value and the tax base is going to give us the temporary difference. And in this case, the temporary difference is 0 because the carrying value and the tax base are the same. So the deferred tax balance would be the temporary difference times the tax rate, but because we have 0 as the temporary difference, we're going to have 0 as the deferred tax balance. At the end of year 1, we're going to have used our straight line depreciation for accounting purposes to depreciate this asset over 2 years. So we would have depreciated $2,500, debit depreciation expense, credit accumulated depreciation for $2,500. So the asset would be on our books, the net book value of this asset would be $2,500, the remaining $2,500. So carrying value can also be thought about as net book value. And what's the tax base? Well, we already could deduct the whole amount. Remember the question said the CRA permits 100% deduction of the asset in the first year. So from a tax perspective, we already would have subtracted $5,000 from our taxable income, meaning that there are no deductions left. There's nothing left that we can deduct in the future. So our tax base of that asset is going to be 0. Our temporary difference is the difference between the carrying value and the tax base. So our carrying value for accounting purposes is $2,500 minus our tax base of 0. It's going to give us a temporary difference of $2,500. And in this case, our book records or our accounting records are going to show a lower income than our taxable income because our taxable income, we've been able to deduct $5,000, but from accounting, we've only been able to deduct $2,500. So we're going to have this taxable difference and times the tax rate of 30%, it's going to give us $750. And because this is reflecting tax that we're going to need to pay in the future, because our accounting income right now is lower than our taxable income, then we're going to have a deferred tax liability. And at the end of year 2, we would have fully depreciated the remaining $2,500 left in the net book value of the equipment according to straight line for accounting records. So our net book value would be 0 at the end of the year. Same thing, our tax base is still 0. So our temporary difference is 0 and our deferred tax is 0. All right, another example. A company has accounts receivable with a carrying amount of $10,000. The related revenue is taxable as it is earned, and tax accounting is the same as financial accounting. So this means that this would be taxed as soon as we earned it, as soon as we recognized it. So it's already been taxed. So the carrying value of the accounts receivable in our financial statements is $10,000, which it specifically says in the question. Now the tax base is going to be our future tax deductions. So, and if it's not deductible in the future, then our tax base is going to equal the carrying value. And guess what? This isn't deductible in the future because it says it was taxed at the same way of accounting. We've already recognized it's already gone through our tax statements. Therefore, our tax base is going to equal our carrying value, which is also going to be 10,000, meaning that our temporary difference is 0. Remember, our temporary difference is the difference between the carrying value for accounting purposes and the tax base. So because they're both 10,000, the difference is 0. So we don't have a deferred tax balance related to this. And again, that makes sense if you think about it, because deferred tax relates to temporary differences in between tax and accounting. So if there's not a difference, we wouldn't expect to have any sort of a deferred tax item related to it. Example number 3. What about a purchase of another company's shares was made at a cost of $1,000? So the carrying value of the shares in our financials would be $1,000. And the tax base would be, what is the tax base? Well, it doesn't say anything about when we're going to get taxed on these shares. But when the shares are sold, we'll be able to deduct our cost from our proceeds. to generate our gain or loss. So therefore, because we can deduct the whole 1,000 in the future at some point when the shares are sold, then our future tax deduction is 1,000. So our temporary difference is 0. Of course, our carrying value is 1,000. We can deduct 1,000 in the future. No temporary difference, meaning that there's no deferred tax implications. And our last example is that a company holds a fully paid for life insurance policy on the company president. The policy has a cash surrender value and a carrying amount on the statement of financial position of $100,000. Well, we know how to fill in our carrying value column. It says it's 100,000. But what about the tax base? Well, the proceeds are not taxable when they're received. So there's no future tax deduction, which means that the tax base is equal to the carrying value. So we're going to have 100,000. So our temporary difference is 0, and our deferred tax implication is also 0. So that takes us through the calculation of deferred tax related to assets. So you can see that we've got the carrying value for accounting purposes and our tax base. Our tax base is simply what we can deduct in the future. And if it's not going to be anything, nothing's going to be deducted in the future, then our tax base is equal to our carrying value. And what that achieves is basically to say, well, there's no temporary difference. If we said, well, if there's nothing deductible in the future, then your tax base is 0, then you would end up with a lot of temporary differences. That wouldn't make sense. So if there's nothing that can be deducted, your tax base is going to equal your carrying value for assets. And then our temporary difference was the difference between the carrying value and the tax base, and you multiply this by the tax rate to get the deferred tax. And we do need to think about whether we've got a deferred tax asset or a deferred tax liability. But if it's something that's going to be taxable in the future, then we know that we're going to have a deferred tax liability. Okay, so let's talk about the tax base of a liability. So when we need to figure out the tax base of a liability, we need to ask ourselves, is the future outflow to settle the liability taxable? Or is there a taxable temporary difference that when this is settled that will result in tax savings, lower taxable income? And if yes, then the tax base is going to equal the carrying value of the asset less the future tax deductions. And this is different because remember that for an asset, our tax base was simply equal to the amount we could deduct in the future. Whereas for the liability, we first start with the carrying value, then we subtract the future tax deductions. And if no, so there's nothing that's tax deductible related to this liability in the future, then our tax base is going to equal our carrying value again, just like assets. And same calculation here, our deferred tax asset is computed by multiplying the difference by the carrying value and the tax base by the tax rate. Let's take a look at an example. So a company has an accrued liability with a carrying amount of $1,000. The related expense that was included in accounting income when the expense was accrued is deductible for tax purposes only when it is paid. So our carrying value from an accounting perspective is $1,000. We've got a $1,000 liability on our books. Now the tax base is going to be the carrying amount of $1,000 minus what we can deduct in the future. Well, we haven't settled it yet, and it says that for tax purposes, we can only deduct it when it's settled. So we can definitely deduct the 1,000 when it's settled in the future. So we're going to have 1,000 carrying value minus 1,000 we can deduct in the future, which is going to give us a tax base of 0. And our temporary difference, which is our carrying value minus our tax base, is therefore going to be 1,000. 1,000 minus the tax base of 0. And then our deferred tax is going to be the 1,000 times the 30% tax rate is going to be $300. And is this going to be a deferred tax asset or a deferred tax liability? Well, when we can deduct this $1,000, we're actually going to have lower taxable income. So this is a deferred tax asset. It's going to reduce our taxes in the future. Now, it's possible to have a tax base of an item that doesn't have a carrying value. And the only thing that I can think of is research and development costs, where they've been expensed through the income statement. So they're not sitting on our statement of financial position. They don't have a carrying value, but the tax authorities say that we can deduct those costs because they have been part of building something bigger. So in this case, the carrying value of these costs, say they're $40,000 in this example, the carrying value on our financials or on our statement of financial position specifically is going to be zero because it was already expensed. But the tax base is going to be $40,000 because we can deduct in the future, we can still deduct this $40,000 that we're being told is eligible. So our temporary difference is going to be 40,000, and then 40,000 times the tax rate. It's going to give us a deferred tax of 12,000. And now is this going to be an asset or a liability? Well, this is going to be a reduction in our taxes in the future. So this is going to be a deferred tax asset. Let's look at a more comprehensive example of the calculation of deferred tax. So assume Chelsea Company reported revenue of $130,000 on its 2020 income statement. For tax purposes, Chelsea reported only $100,000 of taxable revenue, the amount that was collected in cash in the year. So from a tax basis, we're only allowed to include what we've actually collected. The remaining $20,000 will be collected in 2021 and $10,000 in 2022, and the tax rate is 25%. We're asked to calculate the deferred tax and record the journal entries. So let's take a look. So in the first year, we recognized $130,000 of revenue, but we had $30,000 that we hadn't received. So on our statement of financial position, we're going to have a receivable of the $30,000. And remember that deferred tax is based on the statement of financial position. So we're not thinking about the revenue here. We're just thinking about what's on our balance sheet or our statement of financial position. And Chelsea is going to have only the $30,000 left on their statement of financial position because they obviously received $100,000. So that's the carrying value. The future tax deductions, because this is an asset, are going to be zero. So when the $30,000 is received, it's going to be taxed. We can't actually deduct anything from it. So therefore, our tax base is going to be zero. So that gives us a temporary difference of 30,000 because the carrying value is 30, the tax base is zero. So our temporary difference is 30. And if we multiply that by the tax rate, which we were told was 25%, then we're going to get a deferred tax balance of $7,500. Okay. And then, so the $10,000 that we're going to record in year two is going to also have a zero tax base because, again, when we receive the $10,000, we have to tax it. So that's going to reduce our temporary difference to $10,000, which is going to give us a deferred tax balance of $2,500. And then in year three, we're going to collect the remaining $20,000, which by the end of the year, we're going to have a carrying value of zero, tax base of zero, and a temporary difference of zero. And the question is this a deferred tax asset or a deferred tax liability? Well, the difference here is going to result in us having to pay tax on the collection of accounts receivable in the future. So when that is taxed, we're going to have to pay it. Therefore, this is a deferred tax liability. Here's an alternate way of presenting the calculation of deferred tax. It's the same as what we looked at in the table, but it's just presented slightly differently. So we've got the carrying amount of accounts receivable, 30,000. Then we've got the tax base of accounts receivable, which was zero. And the future tax rate, 25%, that gives me the deferred tax liability at the end of 2020 of $7,500. We can also prepare a schedule that shows the taxable amounts by year. So that's going to show us so 2020 is here. So now below we've got 2021 and 2022. So in 2021, we know we're going to have taxable 20,000 that we're adding back to taxable income. As it's collected, that's going to give us 25%. At the 25% tax rate, it's going to give us a deferred tax liability of $5,000. And same thing for 2022 when we collect the remaining $10,000. Okay, so we now covered how to calculate the deferred tax balance. If our temporary difference is related to an asset, meaning that the carrying value is higher than our tax value. So if we have an asset that we carry higher on our books than we have future deductions for in tax, then we're going to have a deferred tax liability because we've got those amounts in our financial statements, meaning that we are going to need to pay tax on those amounts. If our temporary difference is related to a liability, and if the settlement of that liability is going to reduce our tax in the future, then we're going to have a deferred tax asset. And deferred tax expense is based on the change in the statement of financial position, deferred tax asset or liability account from the beginning to the end of the period. So we've been talking about the statement of financial position accounts here, deferred tax liability and deferred tax asset. When we calculate the deferred tax expense, we need to take into account the change. So what do we want? Again, we're thinking about the statement of financial position. So if we want our deferred tax asset to be $10,000, what entry needs to go through our income statement to get us to that statement of financial position amount? So the basic journal entries to record an increase in our deferred tax liability would be debit deferred tax expense and credit deferred tax liability. And the journal entry to record an increase in our deferred tax asset would be debit deferred tax asset and credit deferred tax expense. And it's important to remember, again, we need to take into account the opening position, but these are just the general entries to get us started. So let's take a look at the Chelsea example and let's continue on. So assume this is the first year of operations for Chelsea, meaning that there is no opening deferred tax liability. The calculation of our current or deferred, our current income tax, our deferred income tax, and therefore our total income tax expense for 2020 is shown as below. So we've got current income tax expense, so our taxable income times the tax rate. So we had taxable income of $40,000 times the tax rate of 25%. So we're going to have current tax expense of $10,000. Our deferred tax expense, so we're going to have what we need the deferred tax liability to be at the end of 2020. And we calculated that already at $7,500. If we just scroll back a few slides here, we know that we needed $7,500 as our total accrued tax liability. So this was looking forward for all future years. The sum of the 2021 and 2022 liabilities is going to be $7,500. So that's what we need it to be at. And then we're going to subtract the opening balance in the deferred tax liability account to generate our total deferred tax expense. So in this case, we were told that this is the first year of operations for Chelsea. So our opening balance in the deferred tax liability account is $0. So therefore, our deferred tax expense is $7,500. So the sum of our current income tax expense of $10,000 and our deferred tax expense of $7,500 is going to yield total income tax expense of $17,500. So we're simply summing our current tax expense and our deferred tax expense to come to our total income tax expense. And we will present each of these numbers separately on our financial statements. Taxes due and payable are credited to income tax payable, while the increase in deferred taxes is credited to a deferred tax liability. So let's figure out what the journal entries are for what we just looked at. So we've got current tax expense of $10,000. So we're going to have debit current tax expense and credit income tax payable for $10,000. And then our deferred tax expense is $7,500. We know this is a deferred tax liability because we're going to have to pay that when we collect the accounts receivable. So debit deferred tax expense, that's going to go through our income statement for $7,500, and credit deferred tax liability. So we're setting up that current liability account on our statement of financial position. Okay, at the end of 2021, the second year, the taxable temporary difference, the difference between the carrying amount of $10,000 and the tax base of 0 of the accounts receivable that relates to the 2020 sales is $10,000. So both the current and the deferred tax expense are calculated below. So our current income tax is $90,000 times 25%, which is going to give us current income tax expense of $22,500, which is just a given number, the 90,000. And then our deferred tax expense is, so we know that at the end of 2021, we need our deferred tax liability to be, where are we here? So look down here. So at the end of 2021, we need our deferred tax liability to be $2,500. And at the beginning of 2021, it was $7,500. So the difference is going to be a reduction of $5,000. So we need to reduce our deferred tax liability of $5,000. So, because we have 75 and now we only want 25. So what's going to happen is we're actually going to reduce our total income tax expense. So it's going to be 22,500 minus 5,000, or a recovery of 5,000, which is going to give us total income tax expense of 17,500. And the journal entries to record the income taxes are our current tax expense of 22,500 is going to be debit current tax expense, credit income tax payable, and then our deferred tax liability of the 5,000, which is going to be the recovery. It's actually going to be a debit deferred tax liability of 5,000 and credit deferred tax benefit. Notice in the second entry for 2021 that an income tax expense with a credit balance is often called an income tax benefit. So this is our benefit account that's sitting in a credit position. The entry to record deferred taxes at the end of 2022 is reduced by another 25. So this T account illustrates what's going on with this deferred liability account. So we had put a deferred liability of $7,500 into the account. We had credited the liability with $7,500, and now we're simply reducing the liability out. So we're going to reduce the liability down to $5,000 in 2021, and we're going to reduce the liability down and by another $2,500 in 2022, which is going to give us, in the end, remember that this is a timing difference, so it needs to even out over time. By the time that this asset has been fully collected, we are going to have a deferred tax liability of 0. And as you go through these questions and we're doing journal entries, you can check your work, because as we go through each year, you need to be able to add the changes in the deferred tax liability. In the end, it always needs to balance to 0. That's something that I do when I'm checking my work, and I do find it very helpful. I can often see where I may have gone wrong in my journal entries, so it's a good check. Okay, let's look at another example. So a company sells microwave ovens, including a 2-year assurance warranty. In December 2021, they started selling a new microwave with estimated warranty expense of $500,000 related to the sales. Actual warranty costs were incurred as follows: $300,000 in 2022 and $200,000 in 2023. Income tax payable was $600,000 in 2021 and $440,000 in 2022. The tax rate is 25%. And warranty costs are accounted for in our financial statements using the expense approach, meaning that we accrued the entire $500,000 as warranty expense in 2021 when the microwaves were sold. And we're asked to calculate the total tax expense for 2021, 2022, and 2023, including a schedule of deferred tax assets by year, and record the relevant journal entries. Assume this is the first year of operations for the company and there is no opening deferred tax balance. Okay, so the first year here, which is 2021, we're going to have, let's figure out the tax base of the asset and what the deferred tax implications of that are. So we know the carrying value of the warranty expense is going to be, so this is an expense. So the carrying value of our expense in our financial statements is $500,000 in December of 2021 because we've accrued it in our financials. So we have a liability sitting in our financial statements for $500,000. So our carrying value of the warranty liability in our statements, our IFRS statements, is going to be $500,000. What's the tax base? Well, the tax base is going to be when the costs are incurred. So our tax base of a warranty liability is going to be our carrying value minus our future tax deductions. Well, we can still deduct the entire $500,000 of warranty expenses when the work is incurred. So we haven't deducted anything for tax yet. We still have the entire $500,000 left that we can deduct from our taxable income. So our tax base is therefore going to be the carrying value minus the future tax deductions, which are $500,000 carrying value minus the future tax deductions of $500,000. So that's actually going to yield a carrying value of 0 because we're subtracting 500 from 500. So therefore, we have a deductible temporary difference at the end of 2021 of the difference between the carrying value and the tax base, which is going to be $500,000. And if we multiply that by the tax rate we were given, which is 25%, then we know we're going to have a deferred tax amount at the end of 2021 of $125,000. Now it says that this is a deferred tax account. Why? Why is it a deferred tax asset? Sorry, not a liability. Well, it's a deferred tax asset because it's going to result in lower taxes in the future. Right now, we've already accrued the $500,000 in our accounting income. So it's lower than our taxable income because taxable income's added it back. So therefore, because we accrued more expenses, our financial records are lower. So as we're able to deduct that from taxable income, we'll end up with savings in our tax. Therefore, it is a deferred tax asset. Okay, so now we were asked to prepare a schedule of tax assets. So we can see here we've got for the future years 2020 and 2023, we've got the future deductible amounts. So we're told that the warranty work is going to occur $300,000 in 2022 and $200,000 in 2023, and that's what we're deducting here as it's incurred. Multiply that by the tax rate, we can see that the deferred tax assets are actually going to be realized is $75,000 in 2022 and $50,000 in 2023, yielding the total difference of $500,000 and the total deferred tax asset of $125,000, which is the same $125,000 we calculated above. So it's really important to note that when we calculate this schedule of when the deferred tax assets are going to be realized, that's really only for the notes to the financial statements. The actual deferred tax asset that we're going to be journalizing is going to be the deferred tax asset over the entire course of the asset, which is exactly what we have in that first exhibit here, where we come to the $125,000 deferred tax asset at the end of 2021. So then the calculation of our total income tax expense is going to be as follows. So our current tax expense, which was given in the question, is going to be $600,000. Our deferred tax expense is going to be, we know we need it to be $125,000. That's what we calculated right here, based on the $500,000 temporary difference times the tax rate. We're going to subtract the opening position of our deferred tax asset, which we're told is 0 because this is the first year of operations. So therefore, our ending deferred tax benefit is going to be $125,000. And this is going to, deferred tax benefit net position reduces our current tax expense. So therefore, our total income tax expense is going to be $475,000. And our journal entries to record these is going to be debit current income tax expense of $600,000, credit income tax payable of $600,000, And then we're going to have debit deferred tax asset on our statement of financial position of $125,000 and credit deferred tax benefit, which is an income statement account, for $125,000. So you can see that's how we get to this net position of our tax expense through the income statement being 475, the net of the 600 and the 125 that's going through our income statement. Okay, so now let's take a look at 2022, the next year. So assume that income tax payable is 440. So therefore our total income tax expense is going to be calculated as follows. So we're going to have current income tax expense of 440, which is what we're given. Then we're going to have the deferred tax expense. So what do we want our deferred tax asset to be at the end of 2022? Well, let's go back to our initial calculation here. So at the end of 2022, we have 75,000 is what we want the balance to be based on that lower schedule of the future year 2022. So we're going to have deferred tax asset. We want it to be at 75. We're going to subtract the opening position. So we had 125,000 in the asset, and now we want to lower it. So we have an asset on our statement of financial position right now of 125,000, but we don't want 125,000 in there anymore. Now we want that balance to be only 75,000. So we need to reduce our asset. So therefore, that's going to result in a deferred tax expense. So we're going to have to put that difference to the income statement, and that difference to reduce the asset is going to go through our deferred tax expense account. So because it's an expense, it's going to increase our current tax expense to come to our total income tax expense. So 440,000 plus 50,000 is going to give us a total income tax expense of 490,000. And our journal entries are going to be for current income tax are going to be debit current income tax expense 440, credit income tax payable 440, and then for our deferred tax we're going to have debit deferred tax expense of 50,000, and that's going to go through the income statement, and then we're going to reduce the asset down by 50,000 to get us to that $75,000 position on our statement of financial position, which is where we need to be. And let's finish this off with the last year. So now we're in 2023, which is the last year in the 3 years of this question. We're told that income tax payable is 600,000. So the calculation of our total income tax expense is going to be current tax expense of 600,000, which we were given. And then to calculate our deferred tax, where do we want our deferred tax to be at the end of 2023? Well, by the end of 2023, it will all have been realized. So we want it to be at 0. But what was our opening position? Well, our opening position was 75,000. So now we've got a statement of financial position account in this asset that has 75,000, but I need it to be at 0. How do I do that? Well, I'm going to need to put the difference between 75,000 and 0 through the income statement, through our deferred tax expense, and then we're going to reduce that asset down. So our entry for that is going to be debit deferred tax expense of 75,000 and credit deferred asset of 75,000. So here's an example. Below is just a simple T account just to show what we just went through in this question. And you can check your work to make sure that your deferred asset and liability accounts are netting to 0 by the end of the asset or liability being realized. So here you can see that originally we put 125,000 into the deferred tax asset account because this is going to result in future tax savings when we incur the warranty work. It's going to reduce our taxable income. So, and then as we went on and we incurred some of those costs, then we had less tax savings. So we only had 75,000 of future tax savings in 2022, and then only 50,000 in 2023, and resulting in 0 at the end of the term. Okay, hopefully that makes sense. We will go through some more examples in the tutorial session. But let's move on. Learning objective number 4. Prepare analysis of deferred tax balances and record deferred tax expense. So just to recap, what's the objective of deferred taxes? Well, the objective is to recognize, so when we talk about tax, we want to recognize income tax payable or refundable in the current period. And one way of putting this is to say interperiod tax allocation, which is to recognize tax effects in the accounting period where the transactions and events are recorded for financial reporting purposes. So basically we're doing matching here. So we're saying when we incur the accounting revenue or the accounting expense, we want to try to match the tax expense. So even though we're using different rules, we need to be accruing things from an accounting perspective. So we need to accrue what's going to happen in the future with tax. And this helps our statement of financial position faithfully represent economic reality. And they also will help us reconcile through that income tax expense that we report each year. Okay, let's look at another example. So this is going to have multiple temporary differences. So we're looking at a little bit more complexity here, but we can totally handle it. So in this example, a company reports accounting income of $200,000 in each of the years 2020, 2021, and 2022. The company is subject to a 30% tax rate. It has the following differences between accounting income and taxable income. Royalty revenue. So we've recorded $18,000 of revenue in 2020. We collected at $1,000 per month beginning on January 1st. Insurance premium, we've got $5,000 per year that was expense for accounting purposes in 2021 and 2022, but this can never be deductible for tax purposes. There's a permanent difference. And then we've got the warranty expense. We recognized $30,000 in 2020. We accrued it, but then we actually paid it out as $20,000 in 2021 and $10,000 in 2022. Okay, so the first thing that we need to do is determine taxable income. So we need to do that reconciliation that we did earlier, where we're going to start with our accounting income, and then we need to figure out our taxable income. We need the taxable income because that is going to help us calculate current tax expense, which we definitely need. So we were told that accounting income was flat at $200,000 each year. So we've got that as our starting point. Then we're going to adjust it for the timing differences, permanent or temporary. So revenue from the 2020 sale, we can't recognize it as we did for accounting purposes where we recognized $18,000. We can only recognize it when it's received for tax purposes, so $1,000 per year. So that's where we have that $12,000 and $6,000 in 2021 and 2022. Warranty expense, we accrued $30,000. So we decreased our accounting income from a financial reporting perspective by $30,000 by this extra expense. For tax purposes, because we can only deduct it when we incur the expense, we have to add back the expense, therefore increasing our accounting income. And then we can deduct the expense in 2021 and 2022 as the work is performed or the expenses are incurred. And then the non-deductible insurance expense that we paid out $5,000 and expensed it from a financial reporting perspective in 2021 and 2022. We're going to add that back for tax purposes because we couldn't have deducted that from our taxable income. So therefore, you can see our total taxable income. So we're going to calculate our current tax expense. So we're going to take taxable income times the tax rate that we were given of 30%. And you can see the last line here is our income tax payable and our current tax expense each year. The next thing we need to do is figure out what deferred tax assets and liabilities exist. And we need to know what the tax base of each asset or liability is, compare that to the carrying value, figure out what the temporary difference is or what the difference is, and multiply by the tax rate to get our deferred asset or liability. So let's take a look. So we've got for 2020, the first schedule is for 2020. So we've got accounts receivable related to the warranty. So from a financial reporting perspective, we've got a receivable on our books of $18,000 because we haven't received the cash. Now, our tax basis is going to be are future tax deductions related to that 18,000. Now, when we receive the 18,000, it's all going to be taxed. So there's actually no deductions related to it. Therefore, the tax base is 0, no future tax deductions. So the difference then between the carrying value and the tax base is going to be 18,000. And if we multiply that by the tax rate of 30,000, we get a deferred tax balance of $5,400. Now you can see in this schedule, they're saying the tax base minus the carrying amount gives us the temporary difference. And they're saying that if it's in brackets, once we multiply it by the tax rate, it's a liability. And if it's not in brackets, it's an asset. So you can see that because the tax base was 0, but our carrying amount was 18,000, that we ended up with a deferred tax liability. And that's because when we receive the 18,000 in cash, we're going to actually have to pay tax on it. So it's a liability in the future that we're going to have to pay out when we receive that $18,000. Warranty liability. So our carrying amount of the warranty liability is an expense. So this is the opposite. The accounts receivable is obviously an asset. Warranty liability is a liability. So our carrying amount in our financials is a liability, or a negative 3,000, because it's a credit balance. The tax base is going to be 0, because the tax base is the carrying amount for a liability. Remember, it's the carrying value minus the future tax savings. And so we can save the 30,000 when we incur the warranty costs, we can deduct them all for tax purposes. But our carrying value is also 30,000. So our carrying value minus the future tax savings is going to give us a tax base of 0, which means that our temporary difference, the difference between the tax base and the carrying amount, is going to be 30,000 times the tax rate is going to give us a deferred tax asset of $9,000, because we will be able to reduce our taxable income when we incur the costs for the warranty that we've just accrued right now. So that's why we have tax savings of $9,000. So the net of a deferred tax liability and a deferred tax asset is going to give us a deferred tax asset of $3,600. And because this was the first year, there's no opening position. So we're going to increase the deferred tax asset by $3,600. So let's find the journal entries for that. Here we go. So we've got debit deferred tax expense for $63,600, credit income tax payable for $63,600, and that was from that schedule we saw where we took our taxable income times the tax rate. And then debit deferred tax asset of $3,600 to set that amount up on our statement of financial position, and then credit deferred tax benefit, which is an income statement account. Okay, so so then let's look at 2021, what our temporary differences in our deferred tax amounts are going to be. So accounts receivable, same thing, we've got a tax base of 0, but now we've collected 12,000, is it 12,000 of that amount? So we've got 6,000 of a carrying value left. So our temporary difference, the difference between our tax base and our carrying amount, is going to be 6,000 times the tax rate. So now we have a deferred tax liability of only 1,800. So we're reducing our tax liability or future tax outflows. And then the warranty liability, same thing, our tax base is 0 because we can deduct it all. Our carrying amount is 10,000 because we already incurred 20,000 of the costs. So that temporary difference times the tax rate is going to give us a warranty liability of 3,000, which is a tax asset. Sorry. So our net deferred tax asset is now 1,200. Our opening deferred tax asset was 3,600. So we have a statement of financial position account with 3,600, but we only want it to have 2,400. So how do we make it happen? Well, the difference is going to need to go through the income statement so we can adjust that balance sheet account to where we need it. So we are going to have that amount go through as deferred tax expense. So the adjustment to that amount would be $2,400. So we're going to have that go through our deferred tax expense, and we're going to reduce that income tax benefit account as the credit. And at the end of 2022, all the temporary differences will have been reversed. So the balance in the deferred asset and liability account will be 0. So our income statement presentation. So this is just showing, if we look in the middle, this is still just showing our total income tax expense, but this is just giving you a little bit more of a bird's eye view. So we've got our income before income tax, and then we've got income tax expense. So we're going to have our current income tax expense, which is simply our taxable income times the tax rate each year. And then we're going to have our deferred expense or benefit account. So you can see the change in that account that we put through the income statement each period there. So that's going to give us our total tax expense, which is that unlabeled subtotal of $60,000, $61,500, and another $61,500. Another concept that's introduced on this slide is a concept about the effective tax rate. So you can calculate the effective tax rate by dividing the total income tax expense for the period by the pre-tax income reported on the financial statements. And this helps you see like what's going on with your deferred tax accounts particularly. So you can see that our effective tax rate was 30,000 or 30,000 was 30%, sorry, in 2020, and then 30.75 in 2021 and 2022. And that's because of the $5,000 non-deductible life insurance premium that's causing that difference. So this is a common piece of analysis that's done by CPAs, by auditors to try to get another way of analyzing the tax expense to see if it makes sense in light of pre-tax income and to try to understand what's causing any differences in the effective tax rate. It's important to note that the life insurance premium that we added back, that $5,000 in those 2 years, is a permanent difference. So it is not considered in calculating deferred taxes. You didn't see it on a deferred tax schedule, but it still does impact our calculation of taxable income for our current tax expense. And here are the journal entries for the other 2 years. So you can see that we've always got the same current tax expense straight off of that schedule. It's pretty simple. And then for our deferred tax expense, when we needed to reduce that deferred tax asset balance, we had the debit going through the income statement to bring down the deferred tax asset. So you can see that for the $2,400 entry and also the $1,200 entry below, where we are bringing down that deferred asset balance. And as a quick check for my work, I can do a rec for my deferred asset rec. So I put in $3,600 originally into the deferred tax asset. Then I reduced it by $2,400, and then I reduced it by $1,200, which gave me an ending balance of 0 when everything was realized, which is exactly what I need. If you end up with a balance, you need to go back and double check your entries. Learning objective number 5, moving on. Explain the effect of multiple tax rates and tax rate changes on income tax accounts, and calculate current and deferred tax amounts when there is a change in a substantially enacted tax rate. Okay, so accounting standards use the income tax rates that are expected to apply when tax liabilities are settled or assets are realized. So in all the examples we looked at so far, the tax rate was constant. Now the tax rate could change. What happens then? So rates used need to include any rate reductions, and if there is a substantively enacted rate or the tax law is more appropriate, then we need to use this amount. So the effect of a change in the tax rate should be recorded immediately as an adjustment to income tax expense in the period of the change. So here's an example. A company has a temporary difference at the beginning of 2020, a $3 million excess CCA. At a tax rate of 30%, this makes the balance in the deferred tax liability account $9,000. 3 million times 30%. Future taxable amounts will be $1 million per year. On September 10th, it was announced that effective January 1st, 2022, the rate would be 25%. So we can see that our future taxable amounts times the tax rate are going to give us our tax liability. So our deferred tax liability. So you can see that in 2021 and 2022, we're still, sorry, in 2021, we're using 30%. And then the tax rate has been affected down to 25% starting January 1st, 2022. So you can see that we've updated those rates down to the 25%. So we're updating the balance of our total deferred tax liability to take into account the fact that the rate is going to decrease in 2022. An entry must be made on September 10th, 2020 to recognize the decrease in the deferred tax liability account. So the impact of decreasing that rate, decreased our liability by $100,000 for the future taxes that we owe. So we are going to record a debit to our deferred tax liability, reducing our liability, and we're going to increase our deferred tax benefit. And IFRS requires separate disclosure of the future tax expense or benefit due to a change in tax rates. And that's the end of Chapter 18, Part 1. Please join me for the tutorial section so we can work through some questions on all the material that we just covered.